president and co-head of Merrill Wealth Management, a role she assumed earlier this year. It's great to meet you. Welcome to our show.
Thank you, Scott. It's so good to be here.
And congrats on the role.
Thank you.
So this is the central question here, right? We've had this incredible move in the market. Now what?
Yeah, so our research team is thinking about a couple things, Scott. We're looking at equity market rally likely to continue as bond yields we think have peaked.
Okay.
We are squarely in the soft landing camp, and we see an economic slowdown in the back half of next year. And then there's the Fed. So we're looking closely at spending data. And through Bank of America, we have incredible insights into consumers. We bank 66 million consumers at Bank of America, so we can look pretty closely at what they're doing. We're seeing their credit card spending starting to come down a bit. We're seeing
delinquencies tick up a little bit too, right?
And we're seeing mortgage payments obviously a lot higher. I mean, average, we're probably 10% up from last year. So that's impacting financial conditions. Loans are obviously less in demand than they were. So all of that puts us as, the Fed's likely done. Maybe there's one more, but we're near the end there.
I don't want to pin you to a calendar date, obviously, but when you say that the equity rally can continue, are we talking about beyond the end of the year? If you think we're firmly in the soft landing camp and the Fed is likely done, and the economy holds in, as you say, until the end of next year, that runway sounds sort of long.
Yeah, we think the economic slowdown really starts next summer. So we think, equities have some more room to run from here.
When you say it, do you mean that we're going to eventually have a recession because it starts to slow next summer? You do?
Yeah, we do.
Okay, so we're soft landing for now.
Yes, exactly.
I got you.
Yes.
What about the idea of competition for equities? So how do you look at that? Because I feel like that debate is now percolating again, where there kind of was no competition for some. Now it's bonds versus stocks. Maybe stocks are more attractive. How do you answer that?
Yeah, so I think what we have to think about, just for us in wealth management specifically, one, during times of volatility, that is when our advisors are of most value because clients need our help to help them make sense of that. Mm-hmm. There's a difference between information that's thrown at them and insight and advice and guidance. So in our business in wealth management, Eric Schimpf and I, who co-head Merrill Lynch, have the opportunity to lead the most talented advisors we believe in the country. And what they do best, Scott, is really sit on the same side of the table with the client and say, listen, we're going to work through your personal situation, which could be very different from mine, and look across the table at a suite of options and say, here's what we think makes sense for you. So it's going to be really different in wealth management depending on the client and depending on the client's specific goals.
Sure, but just to play off that a little bit, I mean, I could feel, a lot of hand-holding, so to speak, over the last, 18 months.
Sure.
But now it feels like it might be turning. At least the narrative feels like it might be changing. Do we go from hand-holding to say, maybe put your feet into the market a little bit more than you might have had?
Yeah, so if we look at our client trends specifically in wealth management, first off, our clients' cash, so when we look at what's sitting in brokerage cash, could be CDs, could be money market funds, short-term treasuries, we're at levels 3 times of what we were before the Fed started raising rates.
Oh, I could believe it.
So, but we've seen that really level off. We have not seen that grow. In fact, over the last several months, we've seen clients, start to move more into fixed income. So, when you look at some of our biggest flows in our product offerings within our CIO office and our open architecture platform, you see, quite a bit of flows going into our bond ladders that are managed by our CIO office and our separately managed account, like fixed income managers. So that tells us that people are legging in, they're locking in yields, and obviously we're starting to see some money move back into equities. Also seeing clients of interest with alternative investments. More and more clients are wanting access to private markets in the wealth
private equity and things like that. We've been following that a lot too in terms of the makeup of the typical portfolio in the future is not necessarily going to be 60-40. Maybe it's a little bit less here and a little bit into alternatives the way that, people didn't have access or insight or knowledge about before, and now there's a whole suite of different kinds of products.
The alternative space has innovated tremendously. Our alternatives assets at Merrill in clients' hands have doubled in the past 5 years, and that's just innovation. There's evergreen products now available, and clients are just looking for that access that they're getting. We're also seeing clients very interested in tax efficiency. So they're looking at active ways to tax efficient manage their portfolio. And we do that again through our CIO office. And that's really, Scott, part of the wealth management process. Clients, they want insight, they want guidance, but they want things that are personalized to them. And that's what our advisors do so well. They want that holistic advice.
You said something that made me think of, when you said So you'd had all this money in money markets, 3 times as much as you would before the Fed was hiking rates, for example. And now you see a pickup in some fixed income. It's like feels like a 2-step process to get in. It's like, okay, got to get the cash out of the cash, now put the cash in into bonds, fixed income, and then go into equities. What's the moment that happens? What is it?
Well, it's really, it's really different depending on the client. Clients have different risk tolerances. They have different goals. We have clients at different stages of their life, different wealth. We do not come at clients with one set allocation. That's really, again, where the advisor needs to be working with the client. And there's really 2 factors at play. What's changed in the world? How do we feel about that? How do you feel about that as a client? And how has that changed or not changed your financial plan that we work together on, which is not a build it and put it away on the shelf. It's an ongoing process.
Yeah, it's definitely not a one-size-fits-all thing.
It just really depends on each client, and that's again, the advisor-led approach.